Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month nickel, zinc and tin.
LME 3-month nickel. The most significant feature of this market in recent weeks has been, and still is, the very significant lows of 2021 at 15,665, which led to lows of late November 2023, plus this year in January, February, and with some mild finessing the lows of late July and early September in the 15,840 and 15,600 zone, and now in late October, and last week as well as this week. It is at this point that I feel obliged once again to mention the big descending scallop pattern I've been going on about for months now, and what it may mean within the near-term universe. So the key level has been and is the low at 15,840. A significant move below this, and by that I mean you would know it when you see it, a significant break below this would give a potential downside for the descending scallop pattern in the 13,830 zone. It still all comes down to what the market has done and even now might still do with the 15,840 zone. First time around in late July, prices chose to bounce back upwards, and during the start of August sustained the bounce. However, over mid-August, prices had an issue with testing the June 2021 low at 17,095, and I suspect indirectly now flatlining long moving average, currently at 17,355. This suspicion eventually evolved into a mid-July to early September ascending wedge pattern. Then, early 11 weeks ago, prices broke down through the base of the ascending wedge pattern, easily reaching the primary target and close enough to the secondary target for me to choose not to designate it. However, the market then built up again, enough for me to draw a late July to mid-September bullish Andrews pitchfork, since retired, which held with some minor breaches until 4 weeks ago, when prices punched down through the lower time, and the nearby May 2021 low at 16,610. Below this was a fairly free area until we once again reached that key level, the 15,840 zone, 3 weeks ago. At that time, I said about this move lower, and I quote, "This move lower, should it continue, will bring to the fore once again the question I posed right at the beginning of this commentary and have done now for months, the future of the big descending scallop pattern," end of quote. As I've said earlier and many times before, a significant move below this, and by that I mean you would know it when you see it. A significant break move below this would give a potential downside in a descending scallop pattern in the 13,830 zone. I'm sorry for keep repeating, but it is important. Well, after the venture lower 3 weeks ago, prices pulled back up until 2 weeks ago, when the market ran up into the brick wall, consisting of the combination of the declining green short medium moving average, currently 16,570, and the mauve medium moving average, currently 16,560, as well as the nearby May 2021 low at 16,610, turning back down and eyeing once again the key 15,840 zone below. Over the last few days, we have been both above and below this key 15,840 level, teasing us all the time, as there is still no definitive reversal back up, nor significant break lower. The only feature I've even dared to draw for the very recent action has been another October to early November based bearish Andrews pitchfork, which the market is right now testing the upper time, currently at 15,980. I am not in love with this pitchfork. It just seemed to fit, but it is very nascent, very early, and I'm quite prepared in a heartbeat to finesse this to a shallower bearish shift pitchfork for the same move, or retire it completely. It all just leaves me with the same final thoughts I had last week, and I quote, "I'm wondering how long these threats on the downside can carry on before prices give way," end of quote. LME 3-month zinc. 12 weeks ago, prices drove higher, prompted by a small late July to mid-August reverse head and shoulders pattern, up over the June 2021 low at 28.10, over the broken old dark blue upper time, currently at 28.67, of the May to August 2023 bullish shift pitchfork that subsequently acted as an August 23 to April 24 upper bull channel line, then over the short medium moving average, currently at 30.11, the mauve medium moving average, currently at 29.15, a congestion band between 29.58 to 29.65 containing the April 2019 high at 29.59, and a 50% Fibonacci line, the big old 2008 to 2022 move at 29.65, plus further up the green middle tine of the February to August bullish shift pitch walk, as well as over the July high at 30.22, followed by the neckline extension of the September to December 2022 reverse head and shoulders pattern, currently 31.36, where the market finally slowed down and took a breather during early October, and then again over late October, just shy of the June 2018 high at 32.20. I said of this move up 6 weeks ago, and I quote, "Prices have moved higher still to now test what I suppose is the holy grail of this market, the neckline of the September to December 2022 reverse head and shoulders pattern. This could become a seminal moment, so watch carefully," end of quote. Well, after what now looks like a double top over October, prices turned lower, below the green middle tine of the February to August bullish shift pitch walk. This all went back to what I said 6 weeks ago, and I quote, "The question now is whether the market will falter here, much as it did in late May, or will it really go for the higher price?" End of quote. Over the last 6 weeks, I had hoped to see, if not the answer, then the beginnings of the answer. But it was only 2 weeks ago, with the market beginning to tempt the short-medium moving average and the congestion zone below between 29.58 to 29.65, that it finally looked like this may be on the cards. Indeed, my final words 2 weeks ago were from the week before, when I said, and I quote, "Keep a careful watch on the 29.40 zone below and what may or may not happen at and over the neckline above," end of quote. This week, yesterday, and even today, we have seen prices test down once again, down to the 29.40 zone, and fight shy of testing the mauve medium moving average below it. If we look at the action seen at the mauve medium moving average below, you can see that last week it was tested and penetrated, but, and it is still an important but there was not a single close below the mauve medium moving average, nor this week so far. All that being said, we have had a break below the neckline. As I said in recent weeks, I would utilize approximately the 2600 level as a proxy for the neckline of the September to date double top. And so what I had last week labeled as potentials below for this pattern, I want today now label as primary target X down in the 28.50 zone, with a secondary hard to reach target X1 down in the 27.07 zone. I just hope next week I don't regret setting out these targets, as we have barely broken through on the downside these past 2 weeks. LME 3-month tin. Between mid-July to mid-August, prices started their recent build higher, based down at the congestion between 28.835 to 29.005, containing the July 2011 high at 29.005, plus at the time the highly important gold highlighted slowly rising long moving average, currently 31.095, and back then the nearby dark blue highlighted neckline extension for the October 23 to January 24 reverse head and shoulders bottom, currently at 28.595, and finally the 50% Fibonacci line of the March 23 to April 24 move, down at the 27.330 level. All these slowed, stopped, and at the start of August turned prices higher. The pushback up then became stuck in what I can best describe as an accidental congestion area overhead, created by the combination of the medium moving average, currently at 31.685, the short medium moving average, currently 31.670, the 50% Fibonacci line of the March 20 to March 22 move at 31.845, plus the bright red neckline of the thin and tall April base head and shoulders pattern. Yes, that one, currently at 31.995. Prices were stuck there, more or less, until 9 weeks ago, when they broke higher, if temporarily, up over an earlier all-time high from April 2011 at 33.610, and up to the 50% Fibonacci line of the March to October 22 move, up at 34.175. This was breached, but the market could not sustain the break any higher and turn and headed lower, but only as far as the gold highlighted slowly rising long moving average, the same one the market had bounced up from in late July and early August, and also avoided in early September. I said 4 weeks ago about this long moving average, and I quote, "This is a key level, and it asks the question of this market whether it will bounce up from it as it did in late July and early August, as well as to a certain extent back in early September, or will it break it and test the late July base congestion roughly between 28.835 to 29.005. There's a lot of overhang in this market, so if it does break, then we may reach down to the previously mentioned neckline extension or the October 23 to January 24 reverse head and shoulders bottom. End of quote. Well, since that time 4 weeks ago, that is just about what the market has done. Initially, it shadowed the gold long moving average from above until last Tuesday, when during my composing my words for my commentary, the market, and now I quote from my commentary from last week, and I quote directly, until today when prices broke down through it with a vehemence, punching down not only through the gold long moving average, but also the July 23 high at 30,205 and the next congestion at 29,880. This move lower has prompted me to look at the whole August to date action as a possible head and shoulders top pattern with a purple neckline, currently at 31,070. That is just below the gold long moving average. Now, this move lower being just today is not as yet confirmed, but because of the size of the break lower, I feel obliged to at least give some potentials for any move below the proposed head and shoulders top pattern. Thus, the primary potential would be down to the 29,030 zone, with a secondary harder to reach potential down in the 27,170 zone. And that's the end of the quote. Late last week, prices reached the primary potential and halted, unsurprisingly, at a dark blue neckline, where we are now contemplating the market. I have also now formalized target X down at 27,170 as the secondary harder to reach target for this move lower. There is one more point that I'd like to draw your attention to, and it is something I said 3 weeks ago about the move lower. And I quote, there is another very recent pattern possibly developing, and that is the action over last week and the start of this week. Could be the flag part in a possible bear flag. If this comes about and a true break below the gold long moving average would seemingly justify such a break, well, the downside could be measured anywhere between 29,500 down to 29,000 or even 28,250. End of quote. These numbers stood up last week, and we have already achieved 29,500 and 29,000, though not down to quite the 28,250 level, though I am keeping a close eye on it still.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.